Well, good morning, or good afternoon, or good evening, whatever time it is that you're watching this video. What I'd like to do with this video is go through what is known as the accounting cycle. And by the way, my name is Jim Borden. I'm one of the instructors for this course, and I'll be going through, again, what is known as the accounting cycle. So as you can see here, there are 8 steps that make up the accounting cycle. In this video, we'll get through about the first 5 steps. Okay? So let's get started. The first step in the accounting cycle is to understand what is meant by a transaction. So as you can see here, a transaction is any event in a business that affects the financial condition of that business, where items of value are exchanged. So for example, you walk into an Apple store and you buy an iPhone. That's a transaction. You pay your utility bill. You pay your employees. You pay for your advertising. You buy some equipment. Those are all examples of transactions that affect the financial condition of a company. And what we need to do is somehow make sure at the end of the day that those transactions get into our accounting system so that when we prepare the financial statements at the end of the period, all those transactions are reflected in the financial statements. So you can see here another example. Corporation borrows $1,000 from the bank. So what we need to understand is, again, how did this particular transaction affect the company, its financial condition? As we'll learn throughout this course, to be an accountant, you really have to understand what's going on in the business. All these transactions, and there are a wide variety of transactions that could affect the business, and accountants have to understand all of those. So working in the accounting function is a great way to understand the inner workings of a business. So let's continue on here. The next step is to what we call journalize or prepare a journal entry. So again, the first step is a transaction occurs, understand the nature of the transaction. In other words, what parts of the business were affected, what accounts of the business were affected. Okay, so here we see this word account. So an account is any item that we want to keep track of within a business. So there could be all sorts of accounts. There could be balance sheet accounts, such as cash or accounts receivable, inventory, liabilities, shareholders' equity accounts that you learned about in your prior video. And then there could be revenue expense accounts that affect the profitability of the firm. So there's a wide variety of accounts that we're going to be learning about during the course of the semester. And we're going to use those accounts as how we're going to record a journal entry. Okay. So in order to do this, we're going to use what is known as a T account. The reason we call it a T account is that if we draw one of these, it sort of looks like the letter T. And the heading for each of these T accounts will be whatever particular account we're working on, whether it be cash, equipment, inventory, a note payable, common stock, whatever the account might be. Okay. Then the account is divided between a left side and a right side. Now, in the world of accounting, we don't use this phrase as left side or right side. We use the phrase debit to represent the left side of an account, and we use credit to represent the right side of an account. So that's all those terms mean. Debit means do something to the left side of an account. Credit means do something to the right-hand side of the account. So you'll be using these terms throughout the semester. The sooner you understand what we mean by debit and credit, the better off you'll be. So hopefully by the end of this video, you'll have a clear understanding of what we mean by debits and credits and how they work and how we use those terms to help us record journal entries, to record transactions as they occur. Okay. So again, to reiterate, debit means do something to the left side of an account. Credit means do something to the right side of an account. Now we're going to see how this works with the various categories you learned about in the prior video, your asset, liability, and shareholder equity accounts. Okay. You think about a balance sheet. One way to think about a balance sheet, we think about the left-hand side of the balance sheet could be our assets, and the right-hand side of the balance sheet would be represented with our liabilities and shareholders' equity accounts. Also think about the basic accounting equation. Assets equals liabilities plus equity. So assets equals liabilities plus equity. Think of the assets on the left-hand side and liabilities and equities on the right-hand side of the account. Okay. So that's going to be helpful. So that we're going to use the phrase normal balance. So think about the accounting equation. Assets are on the left-hand side of the accounting equation. So we say the normal balance for an asset is to have a left-hand balance or a debit balance. So assets normally have a debit balance. Liabilities and equity accounts, on the other hand, are on the right-hand side of the account, which is the credit side of a T account. So that means the normal balance of liability and equity accounts are to have a credit balance. So to reiterate that once again, the normal balance for an asset is to have a debit balance. The normal balance for a liability or equity account is to have a credit balance. So once we understand what the normal balance should be, then it helps us to remember how do we affect these accounts. One way to think about it, we increase accounts using their normal balance side. So we come down here to this part of the slide, okay, and we see four possibilities: increase or decrease an asset, decrease or increase liabilities or shareholders' equity. What I like to remind students of, as long as you know one of these, as long as you know that to increase an asset, we debit the account. Again, assets normally have a debit balance, and to increase an account, we increase using its normal side. So the normal side of an asset in terms of balance is the debit side. So to increase an asset, we debit it. As long as you know that one, okay, as long as you know that to increase an asset, we debit it, then you should be able to fill in. I wouldn't have to even write these other ones here, right? As long as you know that to increase an asset, we debit it, well, then it naturally follows if we want to decrease an asset, we would do the opposite, which is to credit it. And then we come over to liabilities and equity, we just flip that. So again, if we know that to increase an asset, we debit it, then it will follow logically to increase a liability, we would credit it. So let me just reiterate this once again, okay? Assets normally have a debit balance, which is the left side of an account. Liabilities and equity accounts normally have a credit balance, which is the right-hand side of an account. And then to increase any account, we always increase it using its normal balance side. So therefore, since assets normally have a debit balance, to increase an asset, we debit it. Liabilities and equity normally have a credit balance. To increase those, we credit those. Just a lot of time spent going over just a very small part of the slide, but it's critical that you understand how debits and credits work in terms of increasing and decreasing various accounts. And again, the sooner you get it, the better off you'll be for the rest of the semester. Okay, so let's look at an example down here. Going back to that scenario where the company borrowed $1,000 from the bank. So first off, we have to understand the nature of the transaction, what happened here. Well, the company just got $1,000 cash. So cash is one of our accounts. And it's nice when cash is involved in a transaction, because it's easy to think about, what happened to cash? Did it go up or down? In this case, our cash balance went up. And we have to think about, what is cash? Is it an asset? Is it a liability? It's equity. Going it back again, understanding your balance sheet, cash is an asset. We just said, as a result of borrowing from the bank, our cash balance just went up. So if cash is an asset, How do we make cash go up in terms of a journal entry? We would debit the cash account. So the way we record a journal entry, we write the name of the account, cash, and then we move over to the right side and we write the dollar amount. Right? So this is a debit entry. It's hard to tell that that's a debit to cash. When we write the next line, we'll see. So the first thing, we always write our debit part of a journal entry first, followed by all the credits. So the next question, right, there's our debit to cash, $1,000. The question is, what account would we credit? We just borrowed $1,000 from the bank, which means we owe that bank $1,000. We would call that a note payable. That's a liability. When you owe something, that creates a liability. A liability, again, just increased. How do we increase liabilities? With a credit. So notice how we write these. To record credit parts of a transaction, we indent. So notice here what we did. So now we can clearly see the way this is written. As an accountant, you'd understand that you could read this and say, oh, we must be debiting the cash account and crediting the notes payable account, simply because of the way it's written. We always write our debit part of an entry first, and then to record the account that's going to be credited, we indent the name. And then in terms of the dollar amount, think about there being two columns here, essentially. Right? A debit column and a credit column. So that's why, again, these are in different columns, so to speak. The $1,000 debit to cash is in the debit column. The $1,000 increase in notes payable is in the credit column. Okay? Another part of the accounting cycle, after we record a journal entry, we then post it to the accounts. So think about journals, back in the old days, 100 years ago, or not that long ago, when accountants were doing their work, they would have books that they would record everything in. One book was called the journal. And the journal was essentially a chronological listing of all the transactions that take place. And that's where we would write the journal entries. So one book is the journal. The journal, again, is a chronological listing of all the journal entries as they occur. Another book would be known as a ledger. Think of a ledger, every page in the ledger would be a separate account. So perhaps think of page 1 in the ledger as being our cash account. You flip it over, page 2 is accounts receivable. Page 3 might be inventory. Later on, page 10 might be accounts payable. Later on, your retained earnings account might be, page 30. So each page in the ledger is a separate account. And we keep track of the ledger of sort of the balance, running balance of that account. So at any time you go to the cash page and see what is our balance in cash at this moment in time. So what we need is a way to essentially copy. We record a journal entry in the journal, and then later on we need to essentially copy, or the language we use is post that journal entry to the ledger. Think of ledger for our purposes, those T accounts that we've been working with previously. So here we started, it's a brand new business. We see a cash account and a notes payable account here. BB, so if it's a brand new business, beginning balance, be 0 for each of these. Note, we write the beginning balance on the normal side of the account. So cash is an asset, its normal balance is a debit balance. Notes payable is a liability, its normal balance is a credit balance. We put that on the credit side. Then we simply record what happened in these accounts. Well, we know we just debited the cash $1,000. So we see $1,000 being recorded in this posting process as a debit, and a note payable, we're recording a credit to the note payable account. So we say at the end of this transaction, cash would have a debit balance of $1,000, notes payable would have a credit balance of $1,000. Okay. One thing to note, every time we do a journal entry, the debits must equal the credits. So total debits must equal total credits. We see here that's the case. We have $1,000 in debits, $1,000 in credits. In addition, if we make sure we do that, then we're going to be sort of guaranteed that the balance, if we record things correctly when we post, then the total of all the debits must equal the total of all the credit balances in our liabilities and equities. That's our fundamental accounting equation. Assets equals liabilities plus equity. All right. So the example we're going to use here for the next several slides is of Wildcat Auto. So Wildcat Auto is a car dealership. They just started business January 2nd, 2023. Bill Jackson is the owner of Wildcat Auto. So on January 2nd, Bill takes $200,000 of his personal money, deposit it into the checking account for Wildcat Auto. In exchange for giving up that money and putting it into the business, Bill gets 10,000 shares of common stock. All right. So the first thing is to think about what is the nature of this transaction. Right? So Bill is giving $200,000 cash to the business. The business now has $200,000 cash. And in exchange for that, Bill now has 10,000 shares to represent his ownership stake in Wildcat Auto. So that's what happened in terms of the transaction. Now we'd record this. And again, what accounts were affected? Again, the easy one to think about is cash was affected. So from Wildcat's Auto perspective, they just got $200,000 cash, so it increased. Cash is an asset. How do we increase an asset? We debit the account. Okay. So to record this, we would debit cash $200,000, and then we need a credit to this. We need to think about what else happened. Well, we just now have a direct investment into the business by the owner. That's what we call paid-in capital. That's part of shareholders' equity. The account we're going to use to represent paid-in capital is our common stock account. Okay. So common stock is part of shareholders' equity. Remember, shareholders' equity consists of the paid-in capital or common stock account and retained earnings. So there's that journal entry. The way we would say this, we'd say, let's debit cash $200,000, credit common stock $200,000. For each of these events, we're going to look at what is the effect in the accounting equation. So down here, this little grid, we've got our accounting equation, assets equals liabilities plus equity. We've got to make sure that every journal entry that we record keeps the accounting equation in balance, that assets equals liabilities plus equity. So come down here, this is journal entry number 1. So what happened here? Well, as we can see, cash increased 200,000, so knocking off the 3 zeros. Cash increased 200,000. Then we common stock also increased 200,000. We record that under the $200,000 under the common stock account. Okay. Question we could ask here: what is the book value of the firm after this transaction? If you were to go back to slide 11, you'll see that we talked about book value as being equal to shareholders' equity. So right now, total shareholders' equity, these two numbers added together, would be $200,000. So the book value after this transaction is $200,000. The other way we can talk about book value, another way to define shareholders' equity equals assets minus liabilities. So right now they have assets, 200,000, no liabilities. So therefore, book value is 200,000. All right. So again, book value is the same as shareholders' equity, which equals assets minus liabilities. All right. Let's go to transaction number 2. There's a total of 4 transactions we'll look at. Okay, on January 2nd. Okay. All right. We put $200,000 into the business, and now the business is using that cash to acquire some assets. So the first thing they do, they buy a building. They pay $120,000 for this. So again, what was affected here? Well, again, cash was affected, paid cash. We have to ask the question, did cash go up or down? Well, in this case, cash is going down. How do we make cash go down? Cash is an asset. How do we decrease an asset? We decrease an asset with a credit journal entry. So that we know we're going to be crediting cash 120,000, but remember when we write a journal entry, we'll always write the debit part of the journal entry first. So we think about what account is going to be debited here. Well, we just bought a building. So we probably have an account called building, and indeed we do. So we debit our buildings account 120,000. As we talked about before, we credit cash 120,000. Okay. In terms of the effect in the account equation, okay, so cash went down. So you could write this one of two ways. In this case, we use parentheses to indicate a deduction, a decrease in that account, or you could have used a minus sign. Either way would be perfectly fine. So cash is going down 120, buildings went up 120. Okay. This is an example of what we call an asset exchange transaction. An asset exchange transaction is one where one asset went up, in this case, the building account went up, another asset went down, in this case, cash. So that's an asset exchange transaction. In terms of the effect on the book value of the firm here, again, look at the book value over here. There was no effect on the book value. So the book value is still what it was from the previous slide, $200,000. Okay. All right, transaction 3. Wildcat bought 4 cars. Again, remember, Wildcat is an auto dealer. What they do is they buy cars, then they try and resell them, hopefully at a higher price. Right? So they bought 4 cars, $20,000 each, on account. So in this case, they did not pay cash for these. They bought them on account, which means they'll pay whatever company they bought these from at a later date. So again, what was exchanged in this transaction? What was exchanged was they got 4 cars in exchange for essentially an IOU. Right? So they got cars in exchange for an IOU. So car and an IOU. That was what was exchanged. Because let's record the journal entry. So we have to think about what happened here. We just got some cars. And remember, what they hope to do is sell these cars. So items of value that a company is trying to sell in the normal course of business, that's what we call inventory. So we see down here. Okay. So our inventory count just went up. Inventory is an asset. How do we make an asset increase? We debit. Right? So we would debit the inventory account $80,000. Now we're going to credit. Again, this created an IOU. IOU is a liability. And there's the liability that we've set up here is an accounts payable. There's some vendor that we buy cars from. We have an account with that vendor. Now we owe that vendor. We owe on that account we have with that vendor. So that balance is going to increase. Went from owing nothing to that vendor to now owing that vendor $80,000. So we need to increase our accounts payable. Accounts payable is a liability. How do we increase liabilities? With a credit entry. So we would credit accounts payable $80,000. Again, note how we indent our credit entries. And the same thing for the dollar balance. The debit is essentially in one column, the credit in another column. Okay. So we'd say debit inventory, credit accounts payable. We increase both accounts. Let's come down here, the effect of the accounting equation. Inventory just increased 80,000. Liabilities just increased 80,000. So notice that kept the accounting equation in balance. The asset side of the equation went up 80,000. The liabilities plus equity side of the balance sheet, or the accounting equation, also increased 80,000. Turn to the effect in the accounting equation, notice again, no effect. Nothing in shareholders' equity was affected with that transaction. Okay, let's go to final journal entry, number 4 here. So on January 7th, they paid $60,000 to the vendor that they bought those cars from. Okay. So again, we need to record this journal entry. And again, if cash is involved, that's usually, to me, the easiest one to think about. Did the cash go up or down? We'll notice here we're paying cash. So we pay cash, that means we're decreasing cash. Cash, again, is an asset. So to decrease an asset, we credit it. So we know we're going to credit cash 60. The question is, what are we going to debit here? So do we buy any more inventory? No, we're not buying any inventory here, right? But what we did do, we reduced how much we owe that vendor by. We reduced our accounts payable. So that's where we're going to debit. Again, accounts payable is a liability. How do we make that go down? We make liabilities go down with a debit entry. So we debit accounts payable 60,000 and credit cash 60,000. And one thing to note here, as you start becoming more familiar with things, you can start abbreviating some of these accounts. So for example, it would be perfectly fine on a quiz or an exam to write accounts payable as A/P for accounts payable. Or you could abbreviate it ACC, PAY, whatever you want to do. You can write it all out, okay? But certainly feel free to abbreviate as long as it's clear what that abbreviation stands for, all right? In terms of the effect in the accounting equation here, you should be able to do this one. So let's see what happened here. We debited accounts payable. That's a liability, so that's reducing accounts payable. And we credited cash, which is reducing cash. So notice the use of parentheses here indicating that both of these went down. Notice the accounting equation is still in balance. The left-hand side of the accounting equation, right? Assets went down 60, and the right-hand side of the accounting equation also went down 60. Right? In terms of book value, notice no effect on book value. All right. So that's the process of understanding transactions, recording the journal entry, and now we would post, next step, we post those journal entries to the accounts. So these numbers here refer back to the particular journal entries that we did. So you may recall journal entry number 1 is where Bill Jackson gave $200,000 cash to the business in exchange for shares of common stock. So there's that journal entry. We post it to the cash account. So there's a T account. Here's the debit side of the account. Here's the credit side. Same for every account, right? So that was it. We go back to that journal entry. We saw that we debited cash 200,000. We credited common stock 200,000. The second journal entry is where we bought a building for $120,000. So we debited our building account 120, and we paid cash, so we credited our cash account. Okay, so there's the 4. You see that there's 4 journal entries, how they affected our T accounts. Let's just look at how we work through the balances in our accounts. Okay, so right now, if someone asks you, what is our balance in cash? The way you calculate the balance in any particular account, you start with the beginning balance, take its normal balance. So in this case, the normal balance is a debit for cash, right? It's an asset. So take your beginning balance, then add all the transactions on that same side. So we started with a debit balance of 0. There's only one other entry on that side, so 200,000, so we'd add that. And then subtract any transactions on the other side of the account. So in this case, there's a total of 180,000 on the other side. So again, to repeat, we start with the beginning balance, add anything on the same side as that beginning balance, 0 plus 200 minus 180. That leaves us with a $20,000 balance on the debit side. The total debits, 200,000, were greater than the total credits of 180, leaving us with a debit balance of 20,000. Okay, let's do one other one. Let's look at accounts payable. So accounts payable is a liability. Its normal balance is a credit balance. So start with the credit balance of 0. Add any transactions on the same side. So add the 80,000 and then subtract any transactions on the other side. So we had 60,000 in total on the other side. So we have 80,000 in credits, 60,000 in debits, leaving us with overall $20,000 credit balance for accounts payable. Okay. So that's how you would get your ending balances. Beginning balance plus all transactions on the same side as the beginning balance minus any transactions on the other side of the account to get our ending balance. And notice our assets, we have 2 of them, cash and building. I'm sorry, we have 3, cash, inventory, and building, all of it debit ending balance. Assets normally have a debit balance. We have 1 liability account, accounts payable, that is a credit balance. And we have 1 shareholder equity account, common stock, that has an ending credit balance. So everything seems good. The next step would be prepare an unadjusted trial balance. Okay. The trial balance is simply where we list every account. So notice here, cash, inventory, buildings. And then we put what is their balance in one of 2 columns, either a debit or credit balance. So we just talked about those 5 numbers, right? The 3 asset accounts all had debit balance. The liability account had a credit balance. The equity account, common stock, had a credit balance. So we add up total debits, we get 220. We add up the total credits, we get 220. That's what we should get when we do a trial balance. Total debits have to equal total credits. The way you sort of make sure that happens is that, first off, you're starting with everything okay in terms of total debits equal total credits when you start. And then as you record each transaction, as long as each transaction record total debits equal total credits, then at the end, when you add everything together, you should get the total debits equal total credits. So that's what the trial balance will show us. Hopefully, you need to get to that point where total debits equal total credits before you go to the next stage in the accounting cycle. Okay. Now, it's possible that total debits don't equal total credits. What does that mean? Well, first off, it means something's wrong. You recorded the transaction incorrectly, or you start off with incorrect numbers. So you can't proceed until you make sure your trial balance equals total debits equals total credits. We should also be aware that just because they equal doesn't mean everything's okay. There are some things a trial balance wouldn't catch. For example, if you ignored a transaction, forgot to record one, and all your other transactions are correct, your trial balance would still be in balance, but it's not correct because it's missing an event, it's missing a transaction. If you recorded the wrong dollar amounts, let's say that transaction where Bill deposited $200,000 into the business in exchange for shares of common stock. Let's say we recorded that as $180,000 on both sides. It's an incorrect number, but the trial balance would still work. So you got to make sure that all your numbers are correct and you're not missing any transactions. Okay. So it's a good starting point. Summarize all your balances. Said before, it's going to lead us to eventually preparing the financial statements. All right. So final slide here. Let's answer some questions. So here's the balance sheet, sort of a balance sheet as of January 7th, the end of the 4 transactions that we've looked at. So notice we've got our total assets of 220 equals total liabilities and shareholders' equity. So we're good. The balance sheet balances. So the first question, what is the book value of the firm? Again, 2 ways to think about this. One way is we just talked about earlier, book value is equal to shareholders' equity. So what is shareholders' equity? Shareholders' equity is $200,000. Another way to think about book value equals assets minus liabilities. Another way to think about liabilities, another word is we can call our liabilities debt. So the book value of the firm is equal to assets minus debt, or $200,000. Okay. Another way that book value is often expressed is on a per share basis. To do this, we simply take the book value and divide by the number of shares. Where does this number of shares come from? To go back to the very first journal entry, where Bill Jackson gave $200,000 to the business in exchange for shares of common stock. How many shares did he get? He got 10,000. So to calculate the book value per share, we take the $200,000 book value, divide by 10,000 shares, we get $20 per share. Next set of questions. How did the firm obtain its assets? Right, so right now, again, the firm has $220,000 in assets. We can see what they consist of: cash, inventory, buildings. So where do they come from? We'll see this question a lot over the course of the semester. How did the firm obtain its assets? The answer to that question, conceptually, will always be the same. There's going to be three potential sources of funding of where companies got their assets from. It's going to be from borrowing, also known as debt or liabilities, and it's going to be from the two items that make up shareholders' equity. The paid-in capital part, so far that's our common stock, and then the second part is our retained earnings. Those will always be the three sources of funding, how companies obtain their assets. So either can be from debt or equity, and equity has two parts: the paid-in capital, which is proceeds they receive from issuing stock, or from retained earnings. All right, so let's look at, for Wildcat, where they came from. So from borrowing, that's our debt or liabilities. That's the 20,000 here. So again, that's company's debt or liabilities. They all mean the same thing. So 20,000 of their assets came from borrowing. Okay. In terms of then looking at the equity part of it, these two are the equity source of assets. So there's debt or equity. The amount from issuing shares of stock, that's the common stock. That's the $200,000. And at this point, the company has no retained earnings. But later on, obviously, we'll see companies that do have retained earnings. These three items, from borrowing, from issuing shares of stock, and from retained earnings, those will always be the three sources of how a company obtains its assets. Okay. Next question, which is what will lead into our next lecture. What does Wildcat going to do with its assets? Why does it have cash? Why does it have inventory? Why does it have buildings? Well, they're going to start running their business, right? Their business is trying to sell their cars. So if they'll sell their cars, they'll use their building as a place to have their employees come into work. They use the cash to pay the employees and the like. So that's what they're going to do with their assets. They're going to run their business and hopefully start generate some income, generate some revenue, incur some expenses, with the hope of generating a profit for the business. So that's where we will end.